So we're 1 minute past the top of the hour, so why don't we kick things off? I'd like to say good afternoon to everyone, and thank you once again for joining us here today. My name is Mike Chimukov. I'm the Director of Wealth here at Alterna. As always, it's great to welcome everyone back to what is now our second wealth webinar of 2025. Today, we're going to dive into what we refer to as the Personal Tax Planning Starter Kit. And I was thinking about it. I was thinking about it earlier today, and I hate to remind everyone, but the tax filing deadline is right around the corner. And with the new year well underway, we figured now would be the perfect time to take a fresh look at your family's tax strategy. Whether you're balancing income between spouses or optimizing RSP contributions or setting the stage for future generations. Smart tax planning today can really be meaningful for saving for tomorrow. And today, we're going to explore some practical ways to make your finances a little bit more tax efficient and hopefully set up everyone's family for some long-term success. Now, before we get started, I'd like to quickly go over some housekeeping items, which I do at the start of every webinar. First and foremost, all participants will remain in a listen-only mode throughout the entire session today. If you do have questions, please feel free to submit them via the chat function. You'll see the box at the bottom of your screen where you can type in your questions, and one of us will attempt to respond to as many questions as we possibly can. Doug will address them toward the end as well. I'd like to also remind the audience that if you do ask a question, please do keep it to a general nature. We cannot get into specific or personal situations. We just will not be able to address those in this forum. And if your question isn't answered, because it's not always possible to get to everyone's questions, please do send us an email at wealth@alterna.ca. We do monitor that inbox on a daily basis, and somebody will get back to you with answers if you do send in a question that way. And finally, because everyone always loves to ask this, but yes, today's session is being recorded, and it will be available on our website shortly after today's session, along with some additional resources that'll be sent to you after the webinar concludes. Now, I'd like to introduce our guest speaker today, Doug Carroll. He's a familiar face to many of you on the line today, but for those that might be joining us for the first time, I'll give you a bit of background on Doug. So Doug Carroll is the tax and estate specialist for Aviso Wealth, which is a key wealth management partner to credit unions across Canada. He brings extensive experience to the table, previously running an estate planning law practice, also serving as an advanced case consultant with both a life insurer and a mutual fund provider. Doug's impressive credentials include a business degree, a Master of Law, specializing in tax, and certification as Certified Financial Planner, CFP, and a trust and estate practitioner. Doug's got over 30 years of experience, and he supports financial advisors in many ways. He writes articles, he provides individual case consultations, and of course, hosting webinars and in-person sessions like the one today. So without any further ado, Doug, I'm going to hand it over to you.
Okay, thanks, Michael, and thanks everybody for joining in on the session that we're having today. I'm going to push it forward to put up the agenda while I'm giving you a little bit of the intro here. And what I want to hit on with the intro, not that it's verbatim necessarily, but I want to underline or emphasize the point that you raised there, that the things that you do today are going to have some effect on what happens tomorrow or in the future. And that is one of the key points to understand about tax planning. We're within about 5-6 weeks of the tax filing deadline. We're at the point where we are filing our taxes in relation to last year. This is not tax planning time for 2024. That's what you're tax filing for what happened last year. What we do this year can affect what happens this year in the ultimate tax reporting, which would be roughly a year from now or further on out in the future. So when you're thinking about your tax planning, do think about what's in front of you for the current year. This is not the point at which you're going to change anything that happened last year. There's some minor things that you might be able to do in the first 60 days of the year, as in RSP contributions that you can do. Well, RSP contributions are not minor, but some relatively few, I'll call it, things that you can do, mainly that you can do RSP contributions in the first 60 days of the year and take a deduction back in the previous year. Otherwise, the things that you did in 2024 are what's going to matter for 2024. So we are looking further out into the future from this point. So the topics that I'm going to get into here is some fundamental tax concepts. And then from that, I'll give you some numbers related to the current year for 2025 and specifically for the province here in Ontario, and then get into some of the common strategies that are involved with people who are looking to do some tax planning for the household. The most common thing, just to take you to the end of the book here, the most common thing that you can do in a household is to try to income split among the family members, and most particularly to income split between the spouses, the parents, if it's a nuclear family that we're talking about. That is the way that you tend to reduce your taxes, being aware of the ways that you can income split legitimately between you, and then potentially doing that with your children. It's not something where you get into terribly complex strategies that businesses would be doing. If you can get down these fundamentals, then you'll be in really good position to try to pay your fair share, but no more than your fair share, and perhaps you can knock it down a little bit by putting whatever is appropriate for you in place among the things that I'm talking about here. So I'll start by just giving an outline of the tax system, which would be for many of you who have filed taxes for a number of years quite familiar. The fact that we have in our income tax system two levels of government, the federal government and the provincial government, that both levy income taxes. And when they do that, they both have progressive tax brackets. Progressive brackets or progressive taxation basically means that you pay higher levels of tax at higher levels of income. It's commonly how income tax systems operate. With other types of systems, for example, uh, with commodity type taxes like the GST, apart from the fact that GST does not apply to everything, it does apply to most things in the economy, but it applies at a flat rate against the things that you're owning. And then the province, depending on province, may levy its own component, which then turns it from the GST federally to the harmonized sales tax, the HST. But it's on a flat rate. With the income taxes, we, depending on how much we have as earnings, will move up through brackets and again pay higher rates of tax on the higher levels of income. And I want to emphasize that point. Because you break through the thresholds, it doesn't mean that the income from down below also is subject to the higher tax rate on the income. It is as you move up, then you add on, and I'll show you the figures so you can see what it is currently. The two ways that you will reduce down your taxes on a personal basis is through tax credits and tax deductions. These are the most common ways, and I don't think there are any significant other ways that it will generally happen. It can through structurally what you do. Income splitting, particularly with others, is a way that you are able to change who it is that's taxed, and that will then again reduce down taxes potentially. So tax credits, what happens with those, and they are more common than tax deductions for personal income tax filing. What a tax credit does is it allows you to reduce the taxes that you otherwise owe, and the credit rate for most of the tax credits is at the lowest bracket rate, both federally and provincially. The federal is 15%, the provincial is about 5%, the crediting rate. So tax credits are quoted generally, depending on how it's being discussed, they're quoted as an amount, and so don't get confused between the amount and what it is worth in terms of the reduced taxes. The effective cash value is the multiplication of the expressed amount times the crediting rate. That tells you then after that calculation how much your taxes will be reduced. If you do have deductions, then deductions are generally much more valuable than tax credits. And that's because deductions are reducing down your income at whatever level it is. If you've moved up through brackets, it brings you down from the bracket that is the top point where the money otherwise would be taxed to you. And because it is up here, whatever here is, and I'll show you the grid in a second of what's happening here in Ontario. The value of the deduction is based on whatever your marginal tax rate is at that level. So hold off on that thought. I'll come back to that. Now, there are some credits that are worth more, potentially even worth more than deductions, and those credits tend to be the political donation credit and the charitable donation credit. So in both cases, you are giving money away to either political causes or to charity, and by having done so, you will get a credit on that. The first on the let's just deal with the charitable. First $200, you get the low bracket rate. When you make a donation in a year, or in total your donations in a year exceed the $200 level, then you get a credit at a high bracket rate. And if you personally are at the highest bracket, then you get a credit at the highest bracket. So it can be quite valuable. Again, understanding that you have given away, you donated in the way that you would like to, and for having done so, you get the benefit of the credit there. So I said I wanted to show you the numbers. I just want to show you first across the country what the top bracket rates are, and I'll explain these distinctions among the different types of income. The top bracket rate is roughly, as you look at the figure in the regular income column, is roughly 50% is the top bracket rate. The capital gains rate is half of the regular income rate, just because of rounding in a couple of those places, because I've reduced these down into integer percentages, but integers, it may look like it's not exactly half. It's just the rounding of that. If you look at Quebec, for example, 53% down to 27. The 27 is actually 26 and a half. So it is actually half the rate that applies on the capital gains. And as you can see, the capital gains, because only half of the capital gain is taxable, it's the lower net tax rate that you're paying on receiving capital gains as opposed to regular income. Regular income would be things like your employment income. It would be interest that you earn on your holdings, whether that's GIC or a high interest account, or if it's a bond that you hold for investments, then interest is taxed at that full regular income rate. And I'll show you the graduated rates that apply in Ontario in just a second. And then the two on the right-hand side, the dividends, those are Canadian dividends that distinguishes between Canadian dividends that you receive from a corporation running a business that pays a dividend to you, and the corporation has paid the general corporate tax rate. That would be the type of dividend that you would receive off of your investment portfolio if you're holding Canadian stocks or mutual funds that in turn hold Canadian stocks and pay out those dividends to you. The furthest one over to the right-hand side, the ineligible dividend, by contra definition to the eligible dividend, the ineligible dividend is one usually where you own your own business through a corporation, and your corporation has been able to use the low tax rate for that's called the small business rate. And because you've been entitled to do that, then the crediting rate on the dividend when paid from the corporation over to you, you being in control of that, you don't get as generous a treatment as for the eligible dividends, but within the corporation that you owned, it paid less taxes. So net between you and the corporation you own, you're getting a positive result by having used the corporation to earn your business income. So leaving those things aside, let's look at what happens across the country. And the highlighting that you see here over on the left-hand side, the bold-faced blue, those are the federal brackets. And then the unhighlighted, if you will, are the provincial brackets that you see, and they layer on top of one another. The top bracket rate is just over $250,000, and it's not quite 54%. It's 53 and a half. But again, for rounding, it's roughly about 54%. And then again, the capital gains rate is the most desirable type of tax treatment at top bracket rate. And we've had the two other types of income that you would receive, the Canadian dividends being those other two columns. So let's leave out that furthest column over to the right here. We're not talking about business planning. We're talking about you as potentially an investor receiving income off of your investment portfolio. As you can see, your preference, if you had to choose, would be to receive a capital gain because you have 27% at top bracket. You have the lowest rate that applies. But as you go down in income level, as you look back over the mid-income levels, then getting a Canadian dividend can be preferable to getting a capital gain. Now, understand that when you get a dividend, you're getting a dividend because you're holding on to stock, and that stock will vary in value, but over the longer term, if you're fortunate, if you made good decisions about how you're holding your investments, you will expect that that will go up in value. And so the price of that is what leads to a capital gain, the price change on that. So it's not a matter of saying, oh, I would like to only get one type of income. They do the Canadian dividends and the capital gains associated with them are connected to one another. You may have capital gains that arise out of other types of holdings that you have, like having foreign stock. Foreign stock dividends are taxed as regular income, so you don't get the preferred treatment, and that's because for a Canadian government, the Canadian government gives preferred treatment because it already collected some tax from the corporation, a Canadian corporation. It then gives an acknowledgement to that in taxing a Canadian personal investor at a lower rate on the dividend having been paid. Whereas a foreign corporation paying a dividend, Canada didn't get any of the revenue off of the corporation's taxes, and so it's just regular income once it comes to an individual who is located here in Canada. So that gives you an idea of what the brackets are. And so let's get into a little bit of the potential that you have for tax planning. There's four different ways that any kind of tax planning might come about. It'll have one or more of these elements associated with it, whether you're talking about an individual, you or me, or we're talking about large multinationals doing something that's much more complex. It's got these four elements attached to it. You're going to have the potential that maybe you can defer off the point in time when taxes have to be paid, which for the time value of money, it leaves you with more of that to work with than if you had to pay it at an earlier stage, and it knocks down then what you have available either to spend or to continue to invest. We have tax sheltering, number two, that just number two on the grid here, not necessarily the priority, but number two, if you are not taxed during the holding of the investment while an investment grows in value, then that's referred to as generically as tax sheltering, and it keeps more of your money being invested for you. The third one here is preferred taxation. And I just talked about two of the preferred taxations, the most common preferred taxation that you would come across, which is the capital gains, only half of capital gains being taxable, and the special treatment that you have for Canadian dividends as a Canadian investor. And the last item here is splitting. So the first three are about the income. The last one on splitting is about who is going to receive the income that we're talking about. So as an example of this, when you make a contribution into an RSP, you get a deduction for what you put into that RSP. So the amount that you put in there, otherwise, if it's coming from employment, would be something that would be taxed to you currently. By putting it inside of an RSP, you get a deduction, which effectively is allowing for you, one, it reduces down the tax that you pay in the current year, but then that money inside the RSP will carry out into the future, and eventually you will draw that out and be taxed on that amount at some point out there in the future. So you defer the tax that otherwise would apply on that amount from being today to being some point out there in the future. And while it's in your RSP, then the growth that happens or the income that it generates is tax sheltered. So it keeps more of it being invested for you. And then when you take the money out, you don't generally get preferred taxation on a withdrawal from the RSP, or when it goes from an RSP over into a registered retirement income fund or a registered annuity as a drawdown. You don't generally get a tax preferred treatment, except for there is this one part that you can take advantage of, which is that the first $2,000 of money drawn from a RIF, Registered Retirement Income Fund, when you're age 65 and over, it is entitled to a tax credit. So you get to knock off, just on the federal basis, 15%. You get to do the same on the provincial. But on the first 2,000 for federal tax purposes, you get to knock off 15%. And so that reduces down your tax bill by, if you take the full 2,000 in a year, it reduces down your tax bill by $300 on that 2,000. So not an enormous tax break, but something that's a continuing year to year. And again, there's a provincial corresponding way that you get the pension credit as well. And then the last item is the opportunity that you have to split with someone else. And this is a lot of what I'm going to be talking about. A couple of the ways that can happen is to set up a spousal RSP, and also that would be on the front end of things of originally saving the money. And then you also have, as another example, when you take advantage of the pension income splitting rules, both of which I'll talk about further on here. Uh, so in terms of why it is that splitting is beneficial, if it's not entirely obvious, and it's not necessarily obvious, I'll come back to the tax brackets that we have. Again, running up through the from the lowest income up to the top income, I brought back the same figures that I had before, the bracket rates, and the title that I had over the second column said previously regular income. The other way to look at this, because I want to compare what happens with marginal tax rates versus average taxes paid. Another way to look at this is to express it as that's the marginal tax rate. So as you break through, for example, $105,775, then the next dollar above that level will be subject to tax at 34% rather than at 31%. So when you do the calculation, and it's a simplified calculation for this purpose, of how much taxes you have paid up to each of these threshold levels, taking just the basic personal amount tax credit that each of us is entitled to, which is just to give us an idea of how much taxes you would pay at each level. You may be entitled to more deduction and more credits, likely you are, but just to give you a distinction between marginal taxes and average taxes, and marginal tax rates and average tax rates, I've done the rough calculation here, and you can see over here on the furthest right column right now that the average tax rate is lower than the marginal tax rate. Pretty much by definition, it must be, because the marginal brackets go up, whereas the average tax it's based on the average tax rate is based on how much tax you pay up to the level of income that you were at, divided by that income. And I'm just showing it at each of the bracket levels right here. When you're doing income splitting, particularly between spouses, if you can push some of the income over from one to the other, then you have the opportunity to then push one of you down brackets, moving the other one up bracket, mind you, at the same time. But because we have graduated brackets, progressive tax system with higher rates at higher levels, then you can be better off for that. So the round example that I like to use is to say, if you've got $100,000 single income earner in a household, then you're going to go through all the brackets up to $100,000. If you can split income between the two of you, and my arbitrary example here, if we're splitting exactly half of the income between the two, then two people making 50,000 will pay less tax than one person making 100,000. So you'll save roughly $7,500 between the two of you. Again, it's not going to be exactly that, but it gives you a sense of how it is that income splitting operates when I look at this. Michael, I'm just going to hold up here. My screen just shook for a second. I just want to make sure that one, we're connected, and two, whether anything came up on your end as I was going through that slide there.
Screen is good, Doug. One question came up regarding the $2,000 pension credit. The question is, does that apply to both the RPP and a RIF? In other words, is the 2,000 the maximum, or would it be 4,000, for example, 2,000 per plan?
It's 2,000 per person per year. Not sure if I have detail of that I'm going to get into further on here, but basically, if you are under the age of 65 and you're receiving income from a registered pension plan, or if you have a predeceased spouse that you continued on with the RIF on, then the pension credit applies to that income, again up to $2,000. If you're under 65, once you hit 65, that's when a RIF, generally RIF income or a registered annuity, would also be entitled to the pension credit. But it is 2,000. That's the federal amount. I can't recall what the Ontario amount is that you get the pension credit on. It might be 1,000. I shouldn't guess, but it's no more than the 2,000 that you get at the federal level. So it's going to add on a little bit more tax break for you, but the federal one is the real beefy one of the two.
Perfect. Thank you.
Okay, so let's look at what the figures look like presently for RSPs and spousal RSP, what you can do with spousal RSP. So basically, with an RSP, when you have income and you have RSP room, you can either put your contributions into your own RSP, or you can put it into a spousal RSP. So you're using your RSP room, and then you have these two choices. Currently, the figures here in 2020. The limit is, just as you see here, $32,490. It is based on your income from last year, and last year being 2024, 18% of your 2024 income up to that dollar maximum. So if your 2024 income was $100,000, I always use round numbers, then 18% of 100 is $18,000. The 32,490 figure would be what you would reach if your income is in excess of $180,500. So if you had a $200,000 income, again, to keep this simple on me, then 18% of 200,000 is $36,000, but you're in excess of the legislated maximum, which does index from year to year. And so you would be entitled to that 32,490. If you haven't used your RSP room from previous years, then that will continue to carry forward to make use of in future years. So I'm just talking here about the credit based on the current year, and then add to that what the amounts were from previous years. So when you set up a spousal RSP, if you choose to do so, you can go ahead and contribute. You don't get any different tax break on the contribution. You get the deduction for the amount that goes into your RSP or your spouse's RSP, or the two of you if you want to split things up between you. The difference, though, is that where you set it up into a spousal RSP, your spouse owns that plan, is the annuitant on the plan, and when the money is withdrawn, it's taxable to your spouse. So you're generally going to do this to set up so that, among other things that you might be doing with your finances, to set things up so that you can somewhat, if not entirely, equalize the drawdown of the income sources that you have later on in life, so that, again, you can take it from that one person at 100 to two people at 50. You're not going to get it down to the penny, but that's what you're generally trying to do. Because the spousal RSP belongs to your spouse, then the draw from that is taxable to him or her. But If the withdrawal is taken from the spousal RSP in the year of contribution or either of the following 2 calendar years, then the income draw is taxed back to the contributor spouse. So that's something to keep an eye on. Just be aware of that you can't do it on a really short-term basis, but you certainly can do it in such a way that perhaps every so often you might set up, if you want to be strategic about it, talk to your advisor about how advisable it might be to do things in this way. You might set up so that a very high income spouse and a very low income, very high income contemplated contributor and a very low income spouse, you might do a contribution periodically as opposed to every single year, so that you can look at that 3-year time frame, make a contribution from the high income person, and then take a withdrawal beyond that 3-year time period in the hands of the annuitant spouse. Now, remember when I say that we are talking about retirement savings. So you don't want to be doing this just so you can go out and have a big dinner or a trip, and possibly put your retirement years in peril by having done so. But it can make sense to do that to try to work the rules in your favor. The example that I use is an actual situation with my wife and myself when our second child was due. I made a large contribution as my wife was planning on remaining home with the kids for quite a few years. I made a large contribution towards the end of the year, and then we counted out the 3-year time frame, took out a large part of that large contribution and the growth that had happened, and we applied it directly to knock down our mortgage. So it wasn't like we were doing some crazy old spending. We were using it in a very conscientious way so that we freed up more cash later on, which then went back to, to bumping up the retirement savings. So we did use up our P room in the course of doing that, but open-eyed that we were doing it in a way that we were arbitraging tax brackets. My contribution in at my tax bracket, which was much higher than what would be the point at which she was drawing that money out years down the road. We're not talking about hundreds of thousands of dollars here, but enough that it made sense for us to do this little move from my high bracket deduction or higher bracket deduction to her drawing out at a fairly low bracket at a time when it was taken into her hands. In terms of making use of RSP contributions, you can only contribute to RSP up until the year that you turn 71, or to December 31st of the year that you turn 71. But if you have a younger age spouse, you can contribute into that spouse's RSP, as long as it's not, you have the room, the room that is available to you. You get the deduction for it, but the person who is the annuitant on the plan determines whether more money can go into the plan. So you can do that up until December 31st that your spouse turns 71. I'm assuming here, just for the sake of the example, that you're the older person and you can't put it into your own, and so you're putting it into your spouse's RSP here. Now, some other ways that you can try to manage between the two of you so that you have investment resources split between you. You're making access to all the plans that are available. There is no such thing as a spousal TFSA. So there is a spousal RSP and a set of spousal RSP rules. One of the main issues being that 3-year timeline. With TFSA, we each have our tax-free savings accounts. It's not to say that you can't split between you in the usage of your tax-free savings accounts. It's just that you cannot contribute directly into the TFSA of your spouse. You can, however, give money over to your spouse, and your spouse can then put into his or her own tax-free savings account. And because the TFSA does have the features, as indicated by its name, that it is tax-free both while money is in the plan and on drawing the money out, then ideally you want to be making use of that in the appropriate ways that you can. to try to have both of you taking advantage of the tax-free savings account. As compared to RSP, you get a deduction when you put the money into an RSP. You get the tax sheltering and then your tax on the way out. With the TFSA, it's almost like it's flipped around. You're putting in after-tax money, but then you get the tax sheltering and no tax on coming out of the plan. Usually, for retirement purposes, you expect that during your working years, you're a higher tax bracket than you will be over in your later years. And so your first priority to accumulate for your retirement savings is almost always going to be your RSP. But that's not to say that you will necessarily max out, put quotes around that phrase, max out your RSP always for all time. However, it will be the primary way that most of us will save towards our retirement years. Your advisor, you can have a conversation. Your advisor has software. They can give you some projections about how you might split things up between you based on the assumptions you make about who's earning what at what points in time, when you're going to draw that money out in your retirement years, what other assets you have. So making use of the TFSA is coordinated with, ideally, it's coordinated with your contributions into RSP. Now, one of the other things that I mentioned earlier on was the pension income splitting rules. What these rules do, as opposed to the RSP, where you're making a contribution to RSP so that the growth is in the hands of your spouse, with the pension income splitting rules, when you draw out of your own plan, whether it's your registered pension plan that pays you an amount, or a registered retirement income fund or registered annuities, both of which the RIF and the registered annuity would have originally been savings that you put into an RSP, and then when you draw down, you shift over into a RIF or a registered annuity. Depending on which of these you're drawing from, you have the opportunity to then split some of that with your spouse. So you are the annuitant on the plan, you are the pensioner yourself. During the course of the year, you receive that income, and having received that income, when you come around to tax filing time, if it fulfills the definition of eligible pension income, then you can make an election between the two of you to split up to 50% over to your spouse to be taxed in his or her hands. You can make a different election each year because you might have varying income between the two of you. Doing the full 50% might be ideal some years, other times it might go in the other direction, or just might be a lesser percentage that you'd be using. Similar to what I was talking about with the pension credit, and in fact, it uses the same definition for eligible pension income. For income splitting purposes, for this pension income splitting, where you have income from a registered pension plan, or again, income that is drawn from a RIF where you had a predeceased spouse, and then you'd be in a new spousal relationship in this application, then that will be allowed to qualify for pension income splitting under the age of 65. But with your accumulating RSP money that you then take over into a RIF or registered annuity, that only qualifies for this pension income splitting from age 65 onwards. And to be really clear about this, if you take a withdrawal from an RSP, directly drawing money from an RSP, even if you're over the age of 65, that does not qualify for the pension income splitting. It's not all that complicated to move from RSP over into a RIF or over into a registered annuity and then draw from that latter plan in order to fall within the pension income splitting rules. But you do hear from time to time about people who thought they were going to be able to split when they just liquidated a whole bunch of money from their RSP, even being over the age of 65 and thinking, oh, well, this is great. We'll do this thing. But otherwise, perhaps they're thinking, as a couple, they're thinking, let's just keep this money in RSP so that we're not having a constant flow that we may not want all of from this point forward. We'll keep that money while otherwise in the RSP, and we'll just pull out some of it this year, and we'll be able to split. No, you won't. You're going to have to take that, some portion of it if you want, and move it over into a RIF or registered annuity in order to make use of this pension income splitting rules. And then what looks similar to the pension income splitting is what you can do with your Canada pension plan when you have when you're both at least age 60 and you want to split the credits that you've accumulated during the course of your relationship. So it's not the credits that you have for all time. If you happen to be high school sweethearts and you lived all the way from age 18 to 60, it will be all those credits. But otherwise, it'll just be those credits that were accumulated while you were together as a couple. In the example that I have here, I've got spouse one having proportionately 2 credits and spouse two having 6 credits, as opposed to the pension income splitting rules, which is one direction. It's going from the person who is the pensioner, elected between the two of them, as they might agree between the two of them jointly, elected to go in one direction over to the other spouse. In the case of CPP credit sharing, you each take all of your balls and you put them into the hopper, and then half come out to each of you down below. And that's either going to be the check that gets issued from the Canada Pension Plan on a monthly basis, or it's going to be the direct deposit, however it is that you get paid on those things. But you're going in 2 directions, both contributing your credits, and then it affects both of your entitlements for the Canada Pension Plan. And whereas the pension income splitting is something that you do on an annual basis when you're filing your taxes, you can decide if you want to do it and the extent to which, up to 50%, you want to make use of it. With the CPP credit sharing, it is a once in a lifetime, effectively, route that you take by contributing those things out and causing the future payments to then come to the two of you based on having split these things up. Once you again have to be at least age 60 in order to make use of these rules.
So Doug, I'm gonna jump in because we seem to your last slide seemed to have sparked a number of questions. So I figured
Okay.
we'll
Here.
try to get to them before we get too far ahead.
Yep.
I'm gonna try to tie some of them in together. So first question was, can you start a RIF at age 65 to do the income splitting? That's one question. And then the other question was, if both my spouse and I are over 65 and have a RIF, can I use that? Can I use that to apply the pension income splitting? I have a registered pension and we split that each year, but now that I have income from my RIF, can we also split that?
Yeah, I both those questions, basically the answer is yes. You're 65, you want a RIF, you can do that, and you're going to qualify then to do the pension income splitting on the amounts that you receive out of that RIF. And in the situation that you have with the couple that's already doing the pension plan, if they wanted to layer onto that the RIF money, they're welcome to do that. Again, you don't have to do all of it. You can decide what percentage works for you to try to get ideally levelized between the two, so that you move the one at the higher brackets down through while the other one comes up. But between you, that'll put you in a better position generally.
Yeah, there's nothing ever preventing somebody from starting a RIF before they're age 71, right? They can start that.
Oh yeah, you can do it. You can do it at even much younger age than that if you want to do that. One of the benefits, not to overdo it, but one of the benefits of having RIF draw is that let's say that you had people, and this is not a usual situation, but somebody might say, "Oh, I'm going to take some of my money out of my RSP. Maybe it's a young retiree. I'm going to pull some money out of my RSP from time to time, and I'm 60 years old. You can even be younger, but if you do that, there's withholding tax if you take money out of the RSP, and so you're not going to get the gross amount that you take out. You're going to get a net amount based on a formula that the CRA has that requires the payor to withhold some of that, which is an advance payment on the eventual calculation of your tax. You're not paying more tax. You're just paying at the time of the withdrawal, as opposed to when you file your taxes further on. If you were to take, if that was something you were doing on a regular basis, you could say, all right, well, I'm going to take this out anyway. What I'll do is I'll RIF a certain part of my money. I'll transfer some of this RSP over into a RIF and then have the RIF payments come to me. There is no withholding on the minimum RIF payments that are made to you over the course of a year, again, understanding, though there is no withholding, that is a taxable amount, and so it could be that you will have to come up with cash around about this time the following year in order to pay the tax on what it is that you drew out. But if you wanted to, then you could set up a RIF at really almost any age, and that'll pay out to you in that form, as opposed to having an RSP withdrawal that you make.
Perfect. And so since we're still on this slide, a few other questions came up regarding the CPP credits. So do you have to decide the CPP credit sharing at the beginning, or can you ever change it? For example, if your spouse passes, and that's one question. And then for CPP credit sharing, do you both have to be drawing the CPP benefit, or can you split the OAS and a defined pension benefit?
Okay. Okay, this is not old age security. OAS doesn't apply to OAS. We're only talking about the Canada Pension Plan. The two main plans that we have for public pensions is the Canada Pension Plan, where each of us have contributed in premiums and then we draw out of it. And then old age security is paid by the government out of current tax revenues. A subset of the old age security is the guaranteed income supplement, which is for alleviation of poverty. But this is not old age security. It is strictly the Canada Pension Plan that we're talking about here. Once you do the CPP credit sharing, it's done, and you you each get your split according to the calculation. There are some implications of a spouse dying, and then continuation of a survivor pension over to the surviving spouse. I not only could I not give you a full explanation of that sitting here, even if we were looking at it and reading it together, it requires a lot of work through. But
Sure.
when you make the decision to split the credits with the CPP credit sharing, then that's it. That's the split between you, and ongoing. That's how things are going to be paid out to you. A different issue that comes up when you have a death of one spouse and the survivor's pension that might run off of that, which will then increase the pension of the survivor spouse. But I don't want to even touch
Yep.
and even general comment about what calculation is on that, because
Fair
I,
enough.
I really can't do that.
Perfect. Thanks, Doug. I know we're
Okay.
running close to the end of time here, so I'll let you get back to the presentation.
Yeah. Okay. So a few other things that you can do with try to split income between spouses. If you have money that you would otherwise give to your spouse, wanting your spouse to invest that money, again, when I say you, I'm talking to you together as the high income spouse. The high income spouse wants to give something to the lower income spouse so that investment income is taxed to the lower person's tax return. It doesn't happen that way just because you give assets away. What you can do, the income off of that on a straight up gift is attributed back to the giver. And so you can set up a loan between the two of you, where the low income spouse borrows the money from the higher income spouse, and you have proper record keeping of that. And then the income off of the loaned money will be taxed to the borrowing spouse. The interest payments, which must actually be made from one to the other, from the borrower to the lending spouse, the interest payments are deduction to the borrowing spouse, but it's income to the higher income spouse. Net, as you work through these things when you're in a low interest rate environment, which we appear to be headed towards right now for really bad reasons because of what seems to be going on in the economy. But when interest rates are low, spousal loans actually can be an effective way to split between spouses who are distinctively high and low income bracket between the two of them. A couple other ways that you can do, or a few other ways that you can split on money which is given from one to the other. You can give money to your spouse. If your spouse puts that into a business, the income off of the business, the active entrepreneurial actions that that person takes, that is not attributed. You could have an exchange where your lower income spouse owns a vehicle, for example, and it's worth whatever the figure might be, $10,000. That's a pretty small vehicle these days, but transfers over the $10,000 vehicle, for which $10,000 in cash comes back, and there's no attribution there because there's a fair market value transfer. And then things can get a little more complex, but manageable, where the attribution that I referred to applies on the first year of income that is generated, but the reinvestment of that income is not attributed. So if you have $100,000 and it earns $5,000 of income, the 5,000 is attributed back to the giver, but then the reinvestment of the 5,000, whatever it earns further on in the future, is not attributable back to the giver. But you have to have really good record keeping to try to keep this in line over the course of a number of years. That might actually be an effective way to split between you. Where there's any gifts or inheritances received by either spouse, perhaps, but particularly by the low income spouse, isolate that so that the low income spouse, so it's clear that belongs to the low income spouse, and any investment income of that is that person's. If you commingle it into joint accounts, then it's going to be difficult to determine whose money did what, and so you probably won't be able to get away from potential attribution in that case, or the record keeping just won't allow you to do what you would otherwise want to do. So keep things separated. You could have a high income spouse paying the household bills, so that the low income spouse's assets, from whatever sources, but particularly from working activities, can then be invested to earn passive income in the low income spouse's hands. And then for charitable giving, I was talking about it earlier, that once you break through $200, the amounts that you make contributions to charity above that is entitled to higher tax bracket, higher tax credits. And Canada Revenue Agency allows spouses to combine up their credits and break through that $200 level, which is kind of a low level now, set years or decades ago, that you get the low bracket rate. So between you, you can file on one person's return and get the higher credit rate that's allowed to you faster than if you each had to contribute in 200 before you get the higher credit rate. With your children, there's a couple of things, or a few things that I thought I'd highlight that you can do to try to, as much as possible, reduce down your, again, full family household tax bill. If there are any government benefits, like the Canada Child Benefit, that are paid to your household, you'd have children under the age of 17. It depends on the household income. But if those amounts are paid to your household, and if you wanted to, you could isolate those amounts that are paid for the benefit of that child. And if you don't need them to, in fact, pay for groceries and other current support that the household is providing for itself in other ways, then you can invest that money on behalf of the child, and there'd be no attribution of that. Like as between spouses, if you give money to a spouse or to a child, a minor child, then the income off of that is attributable back to the parent or a grandparent who tries to do that with a minor child or minor grandchild. Uh, RESPs are a built-in way that you can do income splitting. You don't get a deduction for putting money into an RESP, Registered Education Savings Plan, but, and of course it's for education, when the money comes out of the RESP for the student who is, for the child as a beneficiary who then is a student, that child is taxed on any taxable amounts that come out of the plan, as opposed to you as the parent who put the money in the first place. So you get tax sheltering inside, and then the tax will apply on that income as drawn out. But most often you'll have a child who will, as a student, not be having much, if any, income. And so not only are you pushing over the taxation to the child, you're probably pushing it down to the point where you have minimal to no tax on that. I mentioned about attribution. If you give to your minor child, you have attribution of the income. The exception to that is that where the invested money or the assets have capital gains, then there's no tax on, or there's no attribution on the capital gains. So if it earns interest or dividends, that's attributed, but capital gains are those of the minor child, which then helps inform how it is you invest, if you're what kind of investment choices you make if you wanted to try to get around these rules. And the last point here about in-trust accounts. It's commonly brought up, hey, why don't we just set up this account? We'll just call it an in-trust account, and parent's name will be on there, in trust for the child. Those are an innovation, perhaps you might call it, of the financial industry from decades ago, where the earmarking of that for the purpose of the child might have been what you were trying to do, quite appropriately, trying to set aside money that ultimately you're going to give to the child. But unless you can prove that it was actually operated as a trust, that you really gave up ownership of the money put in there, and that you reported it properly to the Canada Revenue Agency, then it won't actually be treated as a trust. It does mean that you have to do extra tax reporting and prove your actions that you've taken with that money. So talk to your financial advisor, and if necessary, you can speak with an accountant about how to do that in the most effective way if you're trying to. But not likely in most cases will those accounts end up with the tax on the income being taxed on the child. And then with children who are not minors, there's a few things that can happen. One is if you give to them because they're adults now, there is no attribution on any of the investment income. However, if instead of giving to them, you were to do a low interest loan, a very low interest loan, then you don't have the benefit of no attribution. However, if you at least charge what's called the prescribed rate, which is the same rate that's used where you have spouse to spouse loans, then again you do get the advantage of having no attribution at all. One of the ways that you might be able to set things up if you have some older children and younger children is to pay babysitting expenses to the older children if they're in fact doing that, and that's a deduction for one of the spouses. It has to be the lower income spouse. In paying that, has to be legitimate, and in having done so, it will be income to that child. It's likely not going to be really significant, but it does end up being income to that child, which then can generate RSP room, for example, for that child. And then apart from that, if you have children who cross over into being adults, you might have been contributing to RESPs for them in the past. Maybe you keep on contributing, helping them out by, instead of going into their RESP, you give them money that will then go into their tax-free savings account, because that's the point at which you're entitled to TFSA room, is as of the age of majority, age 18. And then we now have the first home savings account, which gives you another place where you can have tax sheltering working for the benefit of someone who is a young person. I'm not going to get into either of those two types of plans in any significant way here, but to say that that they're tax sheltering plans that are available, and so you want to take advantage of them where appropriate. Last thing to touch on here is between spouses, RSPs and RIFs. On the death of one, the plan can roll over to the other without being taxed. If you have a spouse, similarly with the tax-free savings account, any amounts that come out of a TFSA are tax-free to whoever you name as beneficiary. But if you name your spouse as beneficiary, then not only is the amount tax-free, but it can be added to the surviving spouse's own TFSA amounts without requiring or using up their existing room that they're entitled to. Last 2 points here: life insurance, important to protect the income earning capacity of someone to the household. And once you get further on in time and you're thinking more strategically, you can put extra money into what are called exempt life insurance policies, which are the category that includes permanent policies like whole life and universal life. And inside of those policies, money can build up on a tax sheltered basis, which then increases the amount that eventually pays out tax free upon death. Last item and this is my constant reminder: probate is the actually technically the estate administration tax. People get really worried about probate as an estate planning concern. It is a relatively small tax, 1.5%, that applies to a formal estate. It's something to reduce down after you've taken care of all of the primary considerations of your family needs and your income and tax planning. Just don't let it be the leading consideration. Keep things in proportion. So Michael, I'll turn it back to you. I know we're pretty much right at time. We did deal with some questions,
Yeah.
but I'll see what's up here.
Yeah, we tried to answer as many questions as we could, Doug, while you were speaking, and I know I jumped in a couple of times as well. So we are at time, and I do want to respect that. So with that being said, Doug, I wanted to thank you for taking the time to join us as always. And for everyone on the line, if you have questions that we were not able to get to today, please do, first and foremost, if you have an advisor, please do speak with your advisor. They will be able to assist you and guide you through most questions that come up. If you don't currently deal with an advisor, or if you prefer just to email us, you can do so at wealth@alterna.ca, and somebody from our team will certainly get back to you with answers on that. Now, before we wrap up, I just wanted to provide a couple of quick reminders. Everyone who attended will receive a short survey shortly after the webinar concludes. We do appreciate all feedback, and we do use your feedback to make sure that we continue delivering engaging and relevant topics like the one that you heard today. So, and last but not least, a recording of today's session will also be made available to you within the coming days, along with some supplementary materials that will be sent via email as well. So, with that, I wanted to wish everyone a great rest of the day, and thank you, Doug. Thank you to our audience for joining us today, and have a wonderful evening, everyone.
That's right.